2024 market. So we're recording just so that you all know what's next in commercial real estate for the 2024 market forecast. My name is Stephanie Coleman. I am the 2024 Connecticut Chapter President, and happy to have Mike Goman of Goman and York. He's a principal of the company. Mike is a well-established commercial real estate professional with more than 40 years in the real estate industry. He advises municipalities, tenants, corporations, institutional investors, and high net worth individuals regarding commercial real estate investment, acquisitions, developments, all aspects of the real estate cycle. He also serves as president of AccuBranch LLC, a provider of real estate market research and strategic network planning. And it's a branch program implementation service to regional and community banks. He's a licensed real estate broker in 5 states, certified leasing specialist, and certified retail property executive by the International Council of Shopping Centers. Mike was also named 2021 Realtor of the Year by the Greater Hartford Association of Realtors. So, and Mike, I'm sure you can add to that list. That is your very humble list of accomplishments. We're so happy to have you and welcome you to the webinar. I also would like to thank our annual sponsors, BL Companies, Community Investment Corporation, Cohn Resnick, Dime Bank, Gilbert Savings Bank, H. Kulik and Sons, Newtown Savings, Munger Construction, and SIS. Appreciate you supporting the Connecticut chapter of CCIM. Your sponsorship helps us keep the education and programs going, and we truly appreciate it. From a housekeeping standpoint, Mike has a chock-full agenda, and we want to be able to address your questions as he speaks. So please put your questions in this chat. We may have Mike pause and answer a question along the way, or we may save all the questions to the end of the program. But we certainly are interested in your voice and what you have to say. And with that, Mike, I pass the mic.
Okay, thank you, Stephanie, and thank you, both you and Bernadette, for your help in getting things organized for today's session. And welcome to everyone. It's a pleasure to be with you once again. I think we were trying to figure out whether this is the third or fourth year that I've done this program. So let me jump right in. We have a lot of material to get through, and I want to move through it fairly quickly. I think everybody can see my screen now. A lot going on in the industry, that's for sure. Lots to talk about in this year's session. So let's get right to it here. See if I can get my screen to switch. So as Stephanie said, this is all I've ever done is worked in commercial real estate. Started out in Northern Ontario, worked out in Western Canada for a number of years, back to Southern Ontario, then to Houston, Dallas, and then here to Connecticut in 1996, and I've been here ever since. So I'm not going to go through a synopsis of what we do at Goman and York. Feel free to go and have a look at it on our website. But basically, we are a provider of real estate and economic development and planning advice to municipalities, privately held real estate companies, and a variety of institutional clients. So lots going on in that world. The work that we do is sort of a quick summary: the market and financial feasibility, fiscal and economic impact studies, advisory and support around economic development and town planning, and then helping with forming and organizing and all these other functions related to real estate, commercial real estate assets and companies. So let's dive right in here. If you were with me last year, you've sort of seen the format. This is basically a quick overview of what we think are the highlights in different sectors, and then we're going to spend a little time talking about uh, some of the predictions and challenges that we see, and then kind of wrap up with a quick discussion about where we see opportunity. So, starting off with what's going on today in the sectors with office. No surprise here, I don't think, to any of you that are in the industry. Central business district offices and to some degree suburban offices are all being impacted by remote working. And, one of the barometers is this Castle Top 10. It's as good as any of them, and it looks at the top 10 markets. As of yesterday, the weekly barometer was about 46% occupied in these top 10 markets that Castle studies, and that's consistent with what we've seen. In fact, it's better than what we've seen in a number of markets. Uh, we've actually seen substantially lower occupancy in a number of situations. But it's as good an indicator for what's going on out there in office as any we've seen. Remote working's with us to stay. Anybody that thinks there's going to be some kind of return to normal over the next few years, I think is going to be disappointing. We think it may come up. We may get up to in the 70s or 80s of occupancy, but that's still going to leave about 20% or greater space unoccupied or surplus. And I'm sure all of you are seeing the same information. We have seen that the impact of that is being felt in every market around the U.S. and in every class of building. Uh, there are some differences between the large institutional companies and the smaller entrepreneurial companies. The large institutional companies are giving up space for people who can easily remote work. So that's their tax department or their insurance department or payables department, where everything they can do is, in the past they were coming to work to a cubicle, putting on a headset and basically working on their computer all day. They can do that easily from home, and that's what's happening. It allows a lot of interesting sort of possibilities in terms of the expanded labor pool and so on. The smaller companies, entrepreneurial companies, we're actually seeing fairly, consistent daily occupancy at high levels in those small entrepreneurial companies. So I think we'll see that continue. Again, within the smaller companies, there may still be a function or two that can be done remotely, but the entrepreneurial environment tends to require in-person presence much more than the institutional companies do. So it varies by function. Um, this technology that supports remote working is improving at a tremendously fast pace. And we're going to talk about that a little bit in a minute here in a little more detail, but that's going to continue to improve, no question. It's just going to get easier and easier for people to work remotely. Mitigating factors, there's obvious ones. If we saw a major recession or a big jump in unemployment, that might reposition companies leverage opposite their workers, and thereby they may be in a better position to require people to come into the office. I guess we'll wait and see. We don't anticipate anything like that happening in the immediate future. I put one quick example in here that I saw the other day where Bank of America just sort of casually mentioned that over the past 15 years across their entire platform, they have reduced their square footage usage by 40 million square feet. So that's one company. Now, that's the past 15 years. So as the impact of technology was being felt on the labor pool and then was accelerated by the COVID-19 pandemic, I mean, this was a trend and a big change for one company, one good-sized company, but major reduction in spaces. Across the major U.S. markets, I mean, nobody is escaping this trend. We're seeing high teens, low 20s vacancy rates, highest vacancy rates since 1979 in major markets, New York and LA and Atlanta and so on. So nobody's being left untouched here. This next kind of couple of years, just looking at what's going on within buildings that are backed by CMBS loans, The latest data on that shows over 200 million square feet of leases expiring in those buildings. That's Morningstar is a pretty good source for that kind of data on CMBS loans. And of course, about 150 billion in mortgages coming due this year just in the office sector. So lots to think about. Satellite locations, they enjoy sort of a little bit of a preferred status if they're in the suburb where the commute time is low and parking is free and easy. We're seeing some recovery of in suburban offices in certain markets. Co-working space in some markets has really become a huge factor. Dallas now is reporting about 5 million square feet of office space being converted into co-working space. Interesting to see how that plays out long term. We'll have to wait and see on that as we are with a number of other things. This move towards making the office environment or moving the office environment away from the traditional sea of cubicles or independent offices and so on into what I've been calling the cruise ship, look, where there's lounge chairs and low tables and coffee bars and all kinds of things. Is that going to be enough to bring people back, encourage people to come back into work? I think it'll have an impact, a positive impact. I don't think it's going to change the overall trajectory of what's happening out there, but I don't think it's a bad thing, and I think it's probably something that is worth pursuing. All of this is impacting values. We're still seeing a lot of work around this, trying to figure out how to close that bid-ask gap and figure out what things are worth. If there aren't many transactions, in other words, if buildings aren't trading, it's very hard to come up with current comps. And we run up against that in our research work all the time. I mean, there's just not enough transaction volume in office to really give us good data on comps right now. What's out there is okay, but I mean, it's all over the map. It's not indicative. The transaction volume is just too low. Publicly owned versus privately owned companies, there's also some differences in that, and also in terms of public companies or buildings rather owned by public entities, REITs and so on, and large publicly traded companies versus private. The values of the portfolios of office buildings owned by publicly traded REITs they're being adjusted. We're seeing better data on those because they have to recognize what's changing in the value of their portfolio. The privately held portfolios are far less likely to be releasing any kind of information on the change in the value of their portfolio. But the publicly traded REITs, that's a reasonable source of data, probably one of the better sources that's available today on what things are worth. A lot of discussion about conversions. Here at our shop, we've done a lot of work around conversions of office buildings into other things like residential and self-storage, really depending on what's going on in the market and whether the market will support something like that from a cost versus revenues standpoint. Of course, it's also limited by design. You can't lease if you've got real depth between the core of the building and the outside of the building. You can't use much of that inner core. You can't lease an apartment that's 12 by 50, for example. It's just not going to work. So we've done a fair bit of work on those kinds of conversions, looking at the market and financial feasibility, and some will work and many won't. We'll just have to see how that plays out. In that CMBS data, roughly 21% or about 39 billion are predicted to go in default. That's the latest data we've seen. So big numbers. And the last thing that is on our minds a lot here is that the market values and the remote working, all that stuff, the impact of that on office buildings is huge. But we think that one of the factors that's getting overlooked too much is the fact that many of these buildings are now 40 years old or more, 40, 50, 60 years old. And if you're operating buildings like that, you know what I'm talking about. I mean, now you're talking about not just a roof replacement and a lobby refresh. You've got 40-year-old HVAC equipment, 40-year-old elevators. Your curtain wall on the exterior of the building is 40 years old, and you may have leaky windows and all kinds of things. So you know, you really are, it's not just about declining occupancy and your ability to lease it in a normal market. You are in a situation where these buildings are starting to require a lot of upgrades simply because of their age. You know, I was having this conversation earlier today with somebody, and I said, you know, it's people tend to think depreciation isn't real. They tend to think it's a book entry, but it is real. You know, the reality is there's a reason why the IRS lets us depreciate buildings over 40 years or 39 and a half years, and it's because they do depreciate. So GSA, you know, one of the big factors in office vacancy are government entities, both federal and state. And, you know, they are still, in most cases, giving their workforce very liberal ability to work remotely. And that's huge. You know, the Real Estate Roundtable began identifying this several years ago, and correctly so. They sent a letter to Congress and, you know, basically pleading the case that the federal agencies really needed to rethink their requirements for in-person working. You know, roughly 88 million square feet of space that's leased by the GSA is going to expire by 2026. If, you know, half of that gets given back, that's almost, you know, somewhere 40 plus million square feet of space that comes back onto the market. And you can see above that line, a lot of leases and square footage and numbers of buildings. So as a user of office building space, these are big players. And as I said, they tend to have, currently have the most liberal policies in terms of allowing their people to work from home. So that's having a big effect. And we're seeing that pretty steadily. Retail, a little more of a bright spot, at least in strip center retail. It's we've seen some recovery. That last year we ended up with more store openings and closings for the first time in a few years. That's good. We had a pretty good year from a consumer standpoint. A lot of that liquidity that they were sitting on, they built up during COVID. That came back into the market. Now we think it's been largely exhausted, as we said here. We think that 24 is going to be a little bit of a softening in retail sales. 23 reflected the consumer coming back in and spending again. You know, retail sales year over year is noted here a little over 3%. We had a pretty good holiday season, plus 5%. That's pretty good. E-commerce retail sales have leveled off a little bit. Shoppers are showing that they still prefer physical stores. Suburban versus central business district retail, suburban's doing better. You know, people are staying closer to home, and that's causing CBD retail to suffer a little more. Open air is more successful right now versus malls. I mean, here in Connecticut, virtually every major mall in Connecticut is in some level of distress, if not outright bankruptcy. You know, we've seen Enfield Square Mall, the shops at Buckland Hills, Crystal Mall in Waterford, Trumbull Mall, and so on. I mean, they're all in serious financial difficulty and experiencing a dramatic loss in value. And so the regional mall business is the one really dark cloud in retail right now. On the other hand, suburban open air retail has really done well, and we think we're going to start to see some new construction take place in some of the more active. It is happening in the southern growing markets already. Inflation has taken a toll over the last year. The consumer has recovered, came back in, but luxury goods sales are off. People are trading down. They're moving away from the national brands more to the private brands. The private brands, store brands, if you will, are a little less expensive. So we've seen a little more movement towards that. An opportunity going forward is going to be in what to do with these enclosed malls that I talked about a minute ago. They're typically, if they're a big mall, they're around 100 acres of land, well located, lots of rooftops around them, and good access on and off highways and so on. So they're good real estate, and they're going to represent some redevelopment opportunities as the owners adjust to what market value really is for those. If you were with me last year, you saw this slide. I just kept it in. The punchline here is that there's still roughly about 1,900 shopping centers greater than 400,000 square feet that we put into this Class C or worse category, and virtually all of those at some point are going to be something else. They've got to be redeveloped. So again, to my earlier point about opportunity, these properties are usually well located, have good attributes, and they're going to represent good opportunity for redevelopment. Restaurants, tough outcome following COVID, roughly 90,000 closed, depending on whose data you're looking at. The local guys, the casual dining segment, both of those were hit the hardest as people didn't want to come into a restaurant and sit across from other people. They are recovering, but slowly. We've seen recovery in sort of the casual dining segment. But unfortunately, we've lost a lot of local restaurants, local entrepreneurial operators. They went into COVID typically with low liquidity. They've always had low liquidity in that segment. That's being the local restaurant folks. And they got hit by staffing shortages and cost increases and so on, and did what they could to stay alive. But we're still seeing closings happen, but we think that's begun to stabilize. And as we said a minute ago, casual dining seems to be recovering. Expansion is definitely in that quick service restaurant, the fast food guys. Lots of interesting new concepts, both from existing operators and new ones entering new markets. So there's going to be opportunity in our business for finding sites and locating these new QSRs in our markets. Hotels or hospitality, air traffic, looking at those levels, it's basically returned to 2019 levels. Revenue per available room for the year just passed recovered a little bit, came up about 6%. We're clearly seeing in behavior and socioeconomic behavior data that we look at that millennials are very much, they lean more heavily towards travel as an experience as opposed to shopping in a regional mall to buy things. So that is driving a lot of the shift that we're seeing away from, regional mall retail. And we think that's going to continue. That there's no question that this desire for, give me something to do with my friends, teach me something, give me an activity. That is a major focus of particularly younger consumers. As we said, room rates and airfares recovered. It's being driven really by tourism and resort activity. It isn't free spending. There's this definitely a level of price sensitivity. Some of the lower and mid-range stuff is seeing more activity than the luxury range, if you will. Business travel has still got a road ahead of it in terms of recovering. And of course, a lot of that business travel tends to be driven by conventions, and conventions take a year and a half to plan and execute. So we think we'll see more recovery this year as events and conventions really start to come back. Probably be 25 before it comes back in a big way. A lot of these hotels are still reporting staffing problems, and that we think is going to continue for a while yet. Very much a move towards mobile apps for everything. And this isn't people booking things on their desktop computer. This is people booking things on their phone or on a tablet, pardon me, and being able to check into their hotel using their phone and so on. That's definitely going to continue. Some of this travel is being driven by what we call digital nomads, people that can work for a large insurance company, but since they're working from home or working remotely, they can travel all over the country and do whatever they want to do and still work a normal day from a resort hotel or in Phoenix or wherever it might be. So we think that's going to be something we'll see more of as remote working really becomes entrenched. The global outlook for hotel and resort compound annual growth rates, roughly 8% through the next 8 years, 7 years. But hanging over all this is, from a business travel standpoint, is that virtual meetings are definitely here to stay. It's not as common for people to book a flight to Des Moines and fly it on an overnight trip and come back. there's got to be real good reason for that need for in-person. I think many people now would prefer just to do it by Zoom or by Teams or whatever. Yeah, so that's going to have an impact on business travel going forward. A lot of the older hotels, like older office, pardon me, are going to be good candidates for conversion to residential, and in some cases they really lend themselves quite well to that type of conversion. So 1970s, 1980s vintage hotels may be an opportunity. They're at the stage where they really need to be gut renovated if they're going to be competitive in today's world, and that opens up the possibility of converting them to residential as opposed to keeping them as a hotel. SFR, single family residential, still lots of demand out there, but still reduced supply. Higher prices and low transaction volume have been with us now for a little while. The data on mortgage applications show that that's the lowest that they have seen in decades. People are just simply saying, I'm going to stay put and hold on to the current low mortgage rate that I have on my existing house. If I sell, even though I can get a high price for my house, if I sell, I'm going to pay a high price for whatever I move to next, and then I'm going to have to pay a lot more in interest. We like to remind people that over the last 40 years, the average mortgage rate has been 7%. People tend to look over the last 10 or 15, of course, and they're looking at a much lower rate. But what we've really seen happen is a return to long-term historic norms. So we think this mortgage rate is going to be with us. We don't see substantial reduction in that. Some reductions expected for next year, but we don't think we're not going to see 3.5% and 4% mortgage rates for maybe ever again. This BFR, build for rent, the rent growth in that sector slowed down a little bit, and we saw some of the big players exit. They sold their portfolios because they could sell them and get record prices. But some of those guys have come back in and are buying up large numbers of houses. There was 2019 saw 56,000 units being tracked. By 2022, that number virtually doubled to roughly 120. And the projections are that in the next 3 or 4 years, we'll see that jump again almost 50% to about 188,000 units. Southeastern markets are seeing the most of activity in that area, and I think that'll continue for a while. The important point here is that roughly 83 million millennials are outgrowing apartment living. So they're going to come back in. They're going to adjust to the idea that a mortgage rate is 7%. And we will see sellers at some point come back into the market as well for the same reason that they can't defer forever. They're going to move along when they realize that the current rates and so on are with us. So we are anticipating a little bit of a softening in the values of single-family residential. Somewhat of a decline expected in single-family residential home prices. And we think combined with a little more economic certainty, a recognition that mortgages are 7%, still a very good rate if you've been in the business a long time, and that the supply starts to come back. We think we're going to see a big shift on the part of millennials, return to sort of historic norms. Apartment development, this is very, very specific kind of stuff. I mean, we're seeing great variance in markets around the country. About 670,000 units are in construction now and will be opening during this year. You can see that's a big jump from the 440,000 that were opened in 23. But we see some weakness and volatility in certain markets going ahead. And the projects that are in design and approval today and wouldn't start construction probably till late this year or 2025, we think some of those will not go ahead or maybe slowed down. So we expect that new development in this sector will start to show some slowdown in certain markets. Some markets just became frantically overbuilt, and that's not sustainable. So we will see it moderate. And rent growth is clearly moderating as well in many markets. There's still the development challenges like the uncertainty in the economy and interest rates and cost increases and so on. And financing this past year got harder to find, and it's going to stay a little harder to find, depending on the market and depending on the product. It'll still be a little harder to find this year. Financing will still be a little harder to find, and lenders are going to the better quality projects in the strongest markets. We think that'll continue. But it is, as you're looking at it, it is very important to look at it market by market because the variance is dramatic. In markets like we have here in Connecticut, where we just have not had that big boom in new units, like you might have seen in suburban Dallas, for example. We still have a lot of communities here in Connecticut that the last apartment project was built in the 1980s. So market by market, just be careful, look at what's there and what the market will support. But there is still opportunity here in Connecticut in that sector. Self-storage continues to grow. We're seeing more movement towards climate-controlled self-storage and, better designed self-storage buildings. We're seeing self-storage buildings that really look like office buildings until you have a close look at them. So the industry has learned to, move away from the steel roll-up door, flat roof, pretty plain Jane building and turn them into something that communities aren't as opposed to and feel like are actually can be an attractive use in certain locations. Warehouse logistics, again, varies market specific. Huge new construction and rent growth last year. We think there will be some deceleration this year. We're seeing that in certain markets again. But again, like apartments, very specific and requires a little bit of research on the existing inventory and what's out there. And of course, warehouse logistics properties, location is critical. Access to transit and so on, different, whether it's highway or rail or air travel. That's critical. Still feeling the same, like everybody else, same impact of cost increases and interest rate increases and so on. But as long as e-commerce continues to grow, that will be a big driver of new warehouse logistics products. And e-commerce is here to stay. We're not seeing it grow at the same pace, but if it just continues to grow at the same rate as the overall market goes, then we'll continue to see activity. You probably saw this slide if you were with me last year when we did this. This needs to be updated, but this is just a quick graphic showing projects over 100,000 feet in north central Connecticut. You can see Bradley Airport sort of up there to the left in the upper part. This is anywhere from 100,000 feet to over 3 million square feet. This area has become a bit of a hub for that kind of development. So what are we paying attention to here? Of course, this isn't going to come as any surprise. Office, a central business district, anything older in office is going to be of concern. Regional malls, talked about that. Things that are on the boards but haven't started yet. We'll wait and see. Local restaurants and any of these older sectors and hotels, apartments, or industrial. All that stuff is vulnerable. And they may represent opportunities once the current owners recognize the market value is what it is, and they decide not to continue to carry it. From a municipal, as I mentioned at the beginning, municipalities are a big chunk of our customer client base, and there isn't a conversation we've had in recent weeks or months with any of those clients where there hasn't been some discussion of the impact of declines in some of these older commercial real estate projects and the impact of their declining value on the taxable value of the project. So again, if these buildings are over 40 years, they require special scrutiny. Also on our watch list is artificial intelligence. I mean, the impact of this is going to roll out over the next few years. There's a lot being written on it and a lot being discussed. There isn't a convention going on right now in the industry where AI isn't being discussed at some length. The National Retail Federation convention last week in New York I mean, 40,000 people from the retail community, and I would say probably 60% of the presentations and so on were around generative AI and its impact on retail. So, but it's impacting everything. All these uses that we typically talk about are going to see not minor adjustments, but pretty major impact long term by generative AI. And so stay tuned. We're going to be talking about that for a while. Uh, where did this all start? Well, there's an easy answer to say that it began with COVID, but that would be inaccurate. These trends really started back many, many years ago. I first started talking about the issues around regional malls and the difficulties that they were going to face in the early 1990s. And that was at a convention. So this has been going on for a long time. Some of this is resulting from inadequate investment in some of these assets, owners that didn't keep the properties up, and they went into the COVID era with these assets already in trouble. And COVID just brought a fine point to it, and it's continuing to drive it. Tech is going to continue to drive this remote working, as I said, and of course, we still got to deal with this issue of just simply too much retail and office square footage.
Mike,
Yeah,
before you segue out of this industry sector section, we do have a question I thought would be
sure.
perfect for now. Are you seeing any softening of the apartment marketplace with the huge inventory that has come on the market in the past 48 months? That's from Chris.
Here in Connecticut, no. That's the quick answer. Connecticut, in many markets in Connecticut, there hasn't been higher quality apartment projects built until just recent years. We did a report a few years ago for CRDA here for the Capital Region, and I think we ended up with a projection of around 10,000 units that the market could absorb. Uh, Roughly, depending on which project you're counting, we just count ones that are up and operating right at the moment. There's about 3,200 of those have been built and opened and operating. There's probably about the same amount right now that are still that are on the books, either just going to be opening this year or under construction. So, I mean, even with that number, if everything got done, you're somewhere between 6,000 and 7,000 new units. And remember, I said a minute ago that we predicted around 10,000 units. Now, many of you knew Marty Kenny, wonderful guy, great friend. And Marty said to us when we came forward with our 10,000 prediction, he said, "Oh, we got it all wrong. That was, in fact, the market could absorb 20,000." So, you know, I think we've got a ways to go before we get anywhere close to a market that's at full capacity. Now, having said that, that's very specific to the Connecticut markets. Certain markets around the U.S., for every one developer that was building a new project here and around north central Connecticut, if you went down to Dallas, you could find 15 developers in a square mile building 300 and 400 unit projects. So some of those markets are already overbuilt or at risk of being overbuilt. So as I said earlier, it's very, very, very specific. So let's carry on. Predictions. Of course, no surprise, we're going to see a lot of attention paid to converting some of these buildings to apartments. Last year, nationwide, the data shows about 55,000 office or 55,000 units were built by converting office space. And that was about 4 times any of the previous years. The current projections are that there's about 150,000 apartment units that will be created from all types of buildings over the next couple of years. So if you think we use an average of 1,000 square feet for apartments, that's of course including common areas and a bunch of other stuff. But it's as good a benchmark as anything else. So at 150,000, you're talking about 150 million square feet of commercial real estate that's being converted to apartments, pardon me. So still lots of room to move in this segment. The big issue with these conversions, and this isn't going to come as any surprise to the folks on this call, The big issue is, can you make it make financial sense? Can you do it in a cost-effective way? And the biggest barrier to that is the current owner of the office building and maybe their lender finally fessing up, so to speak, to the real value of that building and accepting that it's not worth, $150 or $200 a square foot anymore. It might only be worth 40 a foot. So, we'll see. The focus, of course, is going to be on converting younger buildings. A lot of the buildings that have been converted up to this point have been some of the older buildings, and now it's going to move. It's going to continue to look at everything, but there's going to be more focus on buildings built in the 90s and so on, 80s and 90s, as opposed to buildings in the 60s. So we'll see. Other predictions, it's impacting building design, more open air, buildings with greater flexibility, horizontal mixed use spread across a site as opposed to vertical mixed use. Communities have learned that it's very difficult to put an apartment building above a ground floor level restaurant or retail component on that first floor. Whether it's venting or trash or any noise or any number of things, they tend to be kind of incompatible uses. You'll see them. They're successful in major downtowns of New York and Chicago and so on. But outside of a few of the most urban environments in the U.S., they tend not to be very successful. They tend to be very problematic. So, we're seeing, by the way, the unfortunate thing about the way that's played out is that developers of apartment buildings have said to communities, we're going to put retail and restaurants on the first floor. But when you look at their numbers, they're carrying those spaces at basically zero value. They're almost assuming that they'll never be leased. So that's not good for communities. You don't want to see that happening. Anyway, so we're not going to see in most of our markets in Connecticut, which most of them, of course, are suburban. We're not going to see a lot of vertical mixed use. It's very tough to make it work. There will be a lot of emphasis on building technology as technology just gets better and better. Generally, it impacts building operations as well. Other predictions in retail, we are seeing a move to smaller prototypes. Most of the national chains are looking at their store prototype and essentially kind of concluding that with e-commerce and curbside delivery and buy online, pick up in store and so on, that the actual retail showroom floor, if you will, can be smaller. So we are seeing a lot of attention paid to that. Now, having said that, there are retailers out there, and I'll pick on Dick's Sporting Goods for one, who sort of reject that idea generally, and their view is that they want the customer in the store experiencing their equipment and their merchandise selection, and that the big store with a lot of activity is in fact what sells for them. So I think again it's very focused in certain segments. Quick service restaurants, of course, going to smaller, banks going to smaller. A lot more interest in freestanding, a lot less inclination to have neighbors. What's happened in too many strip centers to some of these national chains is that they've found that all of a sudden their neighbors now are tattoo parlors or yoga studios or storefront churches, non-retail uses, and they don't like the adjacent that doesn't work for them from a competitive standpoint or competitive alignment, as you'd say. So they're more of an interest in doing, let's just do it on our own. We think that'll continue. Retail stores are being reframed a little as billboards and fulfillment centers and showrooms, not simply just a place to deliver goods to a customer, but a broader and deeper function. What they have found in a lot of cases, and a few years ago, there was competition, pardon me, in the retail organization between the internet people and the store people, and they saw each other as competitors for resources within the chain. What's changed, and rightly so, is that they now realize that this all works together. A strong internet presence with a great website will actually drive people into a store, and opening up a store in a given geography will actually drive customers to a website. So much more of integration between bricks and clicks, and that's definitely become part of the landscape. The desire, you'll hear the term frictionless retail, and that means that, we're as a retailer, we're doing everything. We have a store, we have a website. You can buy online, pick up in store. You can order online, and we'll bring it out to you at the curb. You can order online, and we'll deliver it to your house. So as a retailer, we are now in all of these delivery mechanisms, and that is going to be definitely continue to increase as time goes by. We are seeing weakness in retail, specialty retail, particularly in the higher price fashion, jewelry, shoes, and apparel. The focus really in a lot of those segments is on more casual wear. People aren't going into the office, so they don't need the expensive clothing and shoes and so on that they might have felt they needed to have to show up in an office. They're working from their desk at home. So their spending in fashion tends to be more on athleisure wear or casual wear and so on. That's with us, going to be with us as for the foreseeable future. And as I mentioned earlier, this business of experiential retail. If there's a way for a retailer to offer up, teach me something, give me something to do with my friends and so on, that's the way to go. Cannabis, I don't think we need to spend a lot of time, but we've seen a lot of growth in that, and that'll continue. We talked briefly about enterprise, generative AI. Again, the impact of this on our world can't be underestimated. Think of it as a similar impact to mobile phones and the use of the internet. Generative AI basically is referring to AI that can generate text or images or code or general content simply from a prompt, a question, for example. And the focus of that on everything that we work with is huge. And people are coming up with new possibilities, new ideas virtually on a daily basis. The ability of it to increase sales, to get better customer interaction, to innovate, to get better control over operations, and to even cut theft and fraud. I mean, it just represents a lot of opportunity. And we're gonna be talking about that for a long time as it impacts everything we do. Restaurants, for the first time, the eating out spend is actually greater than the grocery spend, and there's a so the enterprise generative AI is going to impact everything that we're all involved with, and it doesn't matter what sector you're in. We're going to be impacted by this. The ability of this to impact productivity and sales and innovation and a variety of operational efficiencies and so on it just can't be underestimated. It's a focus that we're seeing everywhere across all sectors. And the retail sector to some degree is leading the way, but we're seeing it impact everything. And so stay tuned on that. We're going to be talking about that in future sessions, I'm sure. More predictions, restaurants. For the first time ever, eating out spend was greater last year than grocery spend. That's reflecting changes, societal changes, and so on. And we'll see if that holds true. I think it will. Quick service restaurants, fast food, we're seeing different prototypes now, including delivery only. In other words, no dining room. They might have a 4-lane drive lanes, 2 being where customers order from the window, and 2 being where customers are picking up their online orders. So we're going to see more of that kind of innovation. The financing environment we think is going to continue to be difficult. You know, the reality is in a lot of sectors, expenses are going up, income is either flat or declining. Appraised values, of course, in some sectors is at best flat or maybe declining. Certain assets are escaping this, as the ones we've talked about, like some of the higher quality apartment projects and the warehouse logistics. But increased expenses are impacting everybody. Definitely a preference on the part of lenders or investors and buyers, you know, in this typical flight to quality that we usually see in markets like we're in now. In many ways, in many sectors, it's become a tenant's market, certainly office and to some degree in retail, except in the very best markets. So some markets are relatively balanced, some markets are very heavily weighted in the tenant's favor. The focus, of course, as we've been talking about, will continue to be on obsolete properties and the ability to convert some of these. We think there will continue to be more interest in suburban locations and less interest in urban locations for the foreseeable future. And of course, as things tend to happen, we're going to see some things fall apart as a result of all these changes in the market. Interest rates, that's a question we get asked about a lot. I'm sure everybody has seen some of the writing that predicts a decrease in rates. You know, varies, but I think our view is that we won't really see a decrease in rates until mid to late 24, probably anywhere between 1/4 and 1%. We don't think it's going to drop much more than that. We think that we'll see sort of 6% rates being what we're going to be dealing with for perhaps a long time to come. The bid-ask spread is closing up slowly, and that'll continue. Sales activity will continue to be slow. There's just a real reluctance on the part of owners to recognize some of these losses. And if they've got good assets that they can sell at record high prices, the question then becomes, what do they replace that with? Unless they're exiting the industry, they're going to be looking for the next project. And they may be looking at some of these options to convert buildings if they can buy them cheap enough, but it takes a strong stomach to do that sort of stuff. Cap rates, we think, will continue to stay high for the time being, and criteria for lending is going to continue to be tight. Foreclosures in certain sectors, the ones we've been talking about, office and regional mall, they're going to continue to go up. And the reason they're going up still is because there's still been a level of what we call pretend and extend on the part of lenders who just don't want to recognize these losses. So they're extending current financing terms, trying to put it off in the hopes that maybe things will improve a little bit and they'll do a little better. So we're in this extended sort of slowdown, relatively shallow slowdown. I mean, if you look at employment or conversely unemployment, if you look at consumer spending, if you look at GDP growth, if you look at inflation, I mean, the indicators are pretty good, quite frankly. You know, it is not a bad economy that we're in right now, despite some of the dark writing you see about things. It's if you look back over a number of years, it's actually a pretty robust economy. So it's a relatively soft landing. That's what we expected. We think this little slowdown that we're in is going to continue to be the case through this year. The growth in the Sunbelt markets will continue to the way it has. There is a greater recognition of the risk premium involved in owning stuff in Florida and Texas and other places that are subject to weather events and so on. The headwinds we're facing are things like the ones we've listed here: market uncertainty and volatility in costs, interest rate levels, and the cost of debt and equity and the flight to quality. There is very much a bifurcation between assets in the A category, A class assets, and those that are considered B and C. The B and C stuff is going to get traded at perhaps record low prices, especially in office going forward. So Connecticut conversions, the opportunities are probably going to be fairly significant in converting office to some of these uses we've listed here: co-working, apartments, hotels, self-storage, and literally to take some of these larger campus office sites and convert them over to residential or warehouse industrial. So we're going to see a lot more attention on that issue, and we're spending a lot of time on those kinds of projects. Hotels, the older 1970s, early 80s hotels are good conversions to residential. As I said, we'll continue to see freestanding retail growth here in Connecticut, particularly in strip centers, of course, and continued growth in the F&B side, the food and beverage. And as we've mentioned, experiential in arts and entertainment oriented uses. Repurposing retail, so only limited by your imagination on what the market will support, but we've listed a few things here, including last mile logistics locations in these big and baby box retail can be good delivery points. They can be converted to co-working spaces, some of the other things that we've added here. Again, the enclosed regional malls really represent some interesting opportunities. Apartments will continue to see substantial demand for what we call highly amenitized or amenity-rich projects. And the reason is that we still have a lot of communities in Connecticut that haven't seen new apartment projects in quite a while, and they have yet to see one of these amenity-rich projects in their community. So there's still going to be lots of capacity in Connecticut for that kind of projects. We have some markets with job growth, some of them listed here, New London County, Fairfield County, Naugatuck Valley in the Hartford area. Locations for these really ideally are in the transit corridors or where they have adjacency to food and beverage concentrations or recreation opportunities. Industrial continue to be active, very active in Connecticut. Including data centers and cold storage, particularly replacing some of these older, far less energy efficient facilities in the cold storage business. And manufacturing, we're actually seeing some manufacturing come back in. The reality is we are an aging state and historically relatively low growth going back to the 80s. We've had very low population growth, among the lowest in the US here in Connecticut since the late 1980s. So you need to be careful with anything you're doing here in the state. We've listed some of the things that we focus on, market research and costing and so on. Very important to do your homework. The office to hotel or residential, again, here in Connecticut, we think that's going to be an opportunity. And then some of the surplus retail, particularly focused on regional malls, over to some of these other uses. The key is you've got to be able to buy it at a low cost per square foot. We think there's opportunity with out-of-state investors. That's interesting to us. And the reasons are we are a very stable market with relatively high barriers to entry versus what they're used to. And the rents that they can get are good. Lower competition, as I mentioned earlier, when we talk to people from some of these active southern markets, they come here and they like the idea that there isn't 15 other projects going up within a mile of where they're looking. So, and of course, we have existing age properties that 1980s vintage apartments that are vulnerable if you build a new highly amenitized apartment project, vulnerable to be able to pull off tenants from those old projects into the new. We are seeing some interest from foreign investors, and we think the Chinese real estate investors are going to represent an increasing area of interest, area of investor. Historically over the years, we've seen Japanese, we've seen the Canadians, we've seen the Germans, and looks now that the group that we're going to start to see more of is Chinese. Chinese real estate in their home country is in a fair bit of turmoil, and we think that we're already seeing it. We're already seeing more interest coming from Chinese real estate folks. If you don't know what a DST is, a Delaware Statutory Trust, read up on it. A lot more activity happening in that sector, in that using that tool. It's basically a version of a 1031-C exchange. It allows people who are in their 70s and have been actively managing real estate assets and want to get out of the active part, but are willing to be passive investors. It gives them a way to do it. And we could spend an hour on that, but I'll leave it to you guys to look up Delaware statutory trusts and read up on it, but I would do that. We do a lot of work for municipalities. Here are some of the recommendations we have, mainly being proactive and making the regulatory environment better and being willing to utilize incentives, whether that's tax abatements or tax fixing agreements or, cutting building permit fees or making the regulatory environment easier. This is the kind of guidance we're giving to our community or municipal client base now. And the important thing is that these communities have to realize that the industry is changing, whether it's office or retail or apartments or industrial, it's changing. And the municipalities, if they want to continue to be relevant, they have to change with them. So, we'll continue to provide that advice. So, wrapping up here, our assumptions are that if there's no increase in geopolitical instability in places like Ukraine and China and the Middle East and so on, and no other COVID-19, no repeat of that, interest rates do what we expect them to do, or we don't get hit by an energy crisis. Oil is still a factor. It hasn't been recently in recent years, but the long-term history of oil pricing shouldn't be forgotten and its ability to impact our economy. And lastly, any other kind of unexpected shift in key economic indicators. As long as those things continue to stay as they've been described, it's a pretty good place to be. If you've got an A asset, it's a good time to sell it. If you want to redeploy that money into something else, it's not a great time if you own some of these B and C assets, especially if they're in B and C markets. But recognizing their value is probably something that you're going to have to do before too long. It's unavoidable, and it might be the right answer to make that step. There will be redevelopment opportunities as we go along in the next 12, 24 months at historically low cost. And that is of great interest, I think, certainly to us, but it should be interesting to all of us in the industry and to municipalities and state. I mean, this is an opportunity to redevelop a lot of these older assets and turn them into something that's more relevant and more productive to our communities. We are seeing new products and services emerge, and we need to be responding to that. There is a lot of capital out there looking for real estate opportunities and ideas. A lot of that capital has been sitting on the sidelines for the last couple of years, and it's going to come back in. We've seen this. This is simply another cycle. We've seen this. As I started, I've been in this business 40 odd years, and I've seen probably 3 major and at least 3 or 4 minor down cycles, and coming out of each one is opportunity. And this one could be of a historic scale, and we should be thinking of it that way. There's just going to be tremendous opportunity. There are headwinds, the things that we've talked about, geopolitical uncertainty, that's going to be with us. And of course, it's an election year, so we've got some level of political uncertainty here in the U.S. and a little bit of ongoing U.S. Economic uncertainty. But those are headwinds we've been through before. And again, I think the thing to focus on is this is a historic time that we're about to enter into, and there will be a lot of opportunity. Some things are the same. We know we've seen this, but there are also some things that we haven't seen before, whether it's generative AI or some of these other moves that we talked about. There is a level of chaos out there right now and uncertainty. For every data point you've seen here today, there's a countermanding data point, and that we live with here in our shop. So there is a lot of chaos and a level of uncertainty, and that's likely to continue. At least for the next 12 to 18 months through the election and continued recovery from that sort of COVID impact. If you've got patient capital and a bit of a tolerance for risk, this is going to be a great time to be in commercial real estate, and that's the way to think of it. So let me end. We'll go to questions, Bernadette. This is a quote that many of you know, but I think it captures the times that we're in. So thanks for listening. I apologize for the technical hiccup, and Bernadette, it's all yours. Or pardon me, Stephanie.
Sure. Thanks, Mike. And thanks for recovering the the technical difficulty. We appreciate it. And I'm so glad you were able to finish the presentation. We do have a great question from Tom. And it says, he asks, how are municipalities reacting to your advice related to, conversions? Do you see them streamlining permits, timing, flexibility? And I would add to that, do you see municipalities adjusting zoning to allow for these conversions that we see are going to grow even more than what we've seen?
Yeah, that's an excellent question. And the quick answer is that we are seeing communities reaching out to us and asking us to help them refine their regulatory environment, improve their regulatory environment so they can begin not only fixing some of the problems that they can see are occurring in commercial real estate in their communities, but also to help them position them to attract more investment. So we are seeing communities being very proactive and reaching out to us and basically asking us to kind of redesign their environment from the ground up. So that's one category. Then there's the other category that's sort of, hears about it and is interested and would like to know more. And then, of course, there's the communities that, their attitude is, we're just fine, thanks. We don't need to see any changes. So look, 10 years ago, we weren't seeing any communities basically asking for help to make their environment better. Today, we're having conversations about that and conversations which are being initiated by the community. We're having those conversations with quite a bit of frequency. So again, I would break it down into thirds. About a third are being proactive, a third are interested but haven't made a forward commitment on that yet, and then there's a third that, life is good and they're not going to change anything. When we talk to communities about that, and we tell them how other communities in some of these growing markets in the South are dealing with the same sort of issues. I mean, they're willing to look at those as analogs and saying, well, that makes sense. So how do we get there? So it's very encouraging, very encouraging. And I think we'll see more of that.
Thanks. Great. Thank you, Mike. And Tom, I think Mike addressed your last question, is how about training P&Z commissions on Robert's rules? So, if anybody knows Tom Hill, he's got jokes. He also wants to know, Mike, if you're sporting a ponytail. So
No, I unfortunately, it's very hard for me to gather enough hair together to sport a ponytail, but life goes on.
Oh man. Well, I appreciate everyone's time today and joining us. And I'm sure, just like you all, we have to bounce to the next meeting in our day. And look forward to seeing you at our events this year. Check out our website. We will definitely also mail you with what we have coming up. We've got a class in February for continuing education. We'll do deal awards in March. We've got our half-year symposium coming up in June. So stay connected with us, and we appreciate your support and coming out. Enjoy the rest of your afternoon, everyone. Thank you. So long.